In April 2025, something happened that Wall Street analysts, trade negotiators, and farmers alike will talk about for years to come. A single cancellation, one that took mere seconds to issue, set off a cascade of economic chaos across 2 continents. Midway across the Pacific, a cargo ship carrying tens of thousands of tons of American soybeans was rerouted without warning. By the time it changed course, the damage was already done. Trading terminals in Singapore lit up in red, a sudden shock that no one saw coming, but everyone understood instantly. China had just cancelled every major U.S. soybean shipment, effective immediately. And just like that, $1.1 billion in contracts vanished. It wasn't just about soybeans. It was a precision strike, economic, strategic, and deeply symbolic. 40 ships carrying millions of tons of soybeans were ordered to divert, most rerouted to Brazil. And within hours, Chinese buyers replaced every single ton with Brazilian grain. The swap wasn't improvised. It was coordinated. This was no trade dispute. This was economic warfare masquerading as market adjustment. The message was clear: China could walk away from its biggest agricultural supplier in under 72 hours, and do so without economic pain or political backlash. America, on the other hand, was caught completely off guard. Bloomberg was the first to break the story, revealing that China had cancelled orders from 3 of the United States' largest agricultural exporters, Cargill, ADM, and Bunge. The reason given: strategic procurement adjustments. But the timing made the real motive hard to miss. Just 48 hours prior, President Trump had imposed sweeping new tariffs on Chinese goods, $90 billion worth, targeting electronics, metals, and EV components. China didn't just retaliate, they recalibrated. By the end of the week, Chinese importers had secured 2.44 million metric tons of soybeans from Brazil alone, about 1/3 of their typical monthly import volume. The speed of the transition was alarming. American farmers, already operating on razor-thin margins, were left staring at piles of unsold grain. The USDA's April 2025 report confirmed it. U.S. soybean inventories jumped 13%, pushing domestic storage levels to their highest point since 2019. Prices at the Chicago Board of Trade plummeted by over 8%, erasing nearly $500 million in market value in less than a week. In Iowa, the mood was bleak. Grower sentiment hit a 5-year low, and farmers spoke with a mixture of disbelief and anger. "We've been shut out mid-season with no warning and no plan B," said Matt Dunn, a 4th-generation farmer from Des Moines, in an interview with the Wall Street Journal. "This isn't just trade disruption. It's economic isolation." According to estimates from the American Soybean Association, farm incomes could fall by as much as 18% this quarter alone, triggering a wave of defaults and forcing small farms to shutter or sell out to corporate buyers. What's even more devastating is that soybeans weren't just another export. In 2024, the U.S. exported over $14 billion worth of soybeans to China, making it the single most valuable agricultural export line between the 2 nations. China knew this. They knew soybeans hit red states the hardest. And they pulled the plug anyway. "They are targeting Trump's base," said Ched Bone, senior fellow at the Peterson Institute, during a CNBC interview on April 2. And with farmers in 11 Midwestern states now facing moderate to high risk of insolvency, the political cost is rising almost as fast as the economic one. But let's be clear, this move wasn't about hurting the U.S. in the short term. It was about replacing it in the long term. Brazil's rapid rise as China's new top supplier wasn't luck. It was engineered. From 2020 to 2024, Brazil expanded its soybean production by more than 21%, thanks to $11.2 billion in targeted infrastructure investments. And here's where it gets interesting. Much of that investment came directly or indirectly from China. Development banks in Beijing helped finance the expansion of ports like Santos, co-funded the Ferrogrão Railway, and opened new freight corridors from Mato Grosso to the coast, all optimized to move soybeans from field to freighter with maximum efficiency. A Reuters report from February 2025 confirmed it. Transport times from Brazil's interior to the coast have dropped by 42%. That's not just an agricultural achievement. It's a geopolitical one. China didn't just buy soybeans. They bought the supply chain. Bloomberg Intelligence now estimates that Brazil can meet up to 70% of China's annual soybean demand. That's enough to nearly eliminate the US from the equation. And with looser GMO restrictions, fewer environmental safeguards, and preferential BRICS trade agreements, Brazil is not just cheaper, it's more aligned with Beijing's long-term strategy. China's maneuver was also exquisitely timed. The peak profitability window for US soybean exports runs from March to June. That's when American farmers make nearly 40% of their annual revenue. By withdrawing during this critical window, China maximized the impact, creating a cascading market collapse precisely when it would hurt the most. What's more, China paid premiums to do it. Traders cited by the Financial Times said Chinese buyers willingly paid $14 to $22 more per ton to secure Brazilian soybeans, even though the harvest wasn't at peak capacity yet. Why overpay? Because the cost of dependence is higher. Trade analysts in China are already calling it a long-term de-risking strategy. The Ministry of Commerce downplayed the move publicly, citing phytosanitary concerns, fungal residues, and pesticide traces in U.S. shipments. But as of late April, neither the USDA nor the World Trade Organization found any confirmed violations. U.S. soybeans remain well within international food-grade standards. Contamination rates are below 0.01% according to a joint audit from the FDA and GAFTA. There's no precedent for suspending shipments without inspections or warnings, said Andrew Tilton, chief Asia economist at Goldman Sachs. In other words, the safety concerns are likely a cover for something far bigger, economic retaliation disguised as regulation. It's not the first time China has used non-tariff barriers as leverage. But what makes this different is the scale and the speed. Over the past 5 years, China has invested more than $8.3 billion in Latin American logistics networks. That includes equity stakes in the port of Itaqui, the expansion of Brazil's northern grain corridor, and even funding for the Ferrogrão Railway that slashes costs from Mato Grosso by over 35%. According to the Inter-American Dialogue, more than 64% of China's soybean imports now move through infrastructure, with direct or indirect Chinese involvement. This isn't just a trade shift, it's a logistics coup. By embedding itself into the infrastructure that moves Brazilian soybeans, China has effectively insulated itself from U.S. supply chains. In doing so, they've also reduced exposure to American-controlled global choke points like the Panama Canal and the Strait of Malacca. This is supply chain sovereignty on a global scale. And it's working. But if you think this story ends with soybeans, think again. In Q1 of 2025 alone, U.S. corn exports to China dropped by nearly 30% year-over-year. At the same time, China signed a massive 3-year corn import agreement with Brazil's COAB agency, worth roughly $2.6 billion. They also auctioned off more than 1 million tons of previously purchased U.S. corn, citing price volatility and strategic rebalancing. Former USDA chief economist Joseph Glauber didn't mince words. This isn't diversification. It's insulation. If China can pivot this quickly on soybeans and corn, what's next? Wheat? Sorghum? Cotton? At what point does the US lose not just one commodity market, but its agricultural relevance altogether? And let's not forget the broader implications. What happens when China uses the same playbook to exit US markets for semiconductors, for aircraft components, or even for US treasuries? According to HSBC's April Commodities Outlook, China is locking in long-term food and grain import contracts with a wide range of suppliers, including Argentina, Russia, and Pakistan. These deals now cover over 70% of China's grain and oilseed needs. Meanwhile, US agricultural exports to China are down 26% this year, slashing more than $3.2 billion from bilateral trade. And even if diplomatic relations improve, the infrastructure tells a different story. Why would China return to the US market if it no longer needs it? Jennifer Harris, a former advisor to the US National Security Council, put it bluntly in a Bloomberg interview, "What we are witnessing isn't just a shift in trade, it's the intentional dismantling of dependency." The question facing Washington, Wall Street, and the American heartland isn't whether we can win China back, it's whether they are already gone. This is about more than soybeans. It's about leverage, control, and the shifting architecture of global trade. And most of all, it's a test. A test that China seems to have prepared for, and one that America wasn't ready to take. The soybean collapse of 2025 may go down in history not just as a trade crisis, but as a proof of concept. One where a global superpower showed the world it could abandon a $14 billion commodity partnership in under 3 days, with no disruption, no shortages, and no apology. So, if soybeans were phase 1, what's phase 2? Is it corn? Rare earths? Semiconductor fabs? US debt? No one knows for sure. But one thing is certain, the world is watching, and what comes next may redefine the balance of power for decades to come.